Hello and welcome. Today I will show you how to perform the candle volume analytics. Using Wyckoff method, we will cover multiple scenarios for the anticipation tops and bottom, and they will also reveal a powerful strategy to follow to the smart money using the simple candlestick pattern. So if you could subscribe to the channel and stick around for the full video. Nearly a century ago, Richard Wyckoff began the publishing his method of detecting supplies and demand imbalance in the market. Wyckoff introduced this discovery that it was possible to measure the forces of the buying and selling pressure in any trade market. Wyckoff's method proved that the future price moves were foreshadowed on the price chart because the combustion man, the smart money, must leave its trading footsteps on the price chart due to the sheer size of the trading volume. So the supply and demand imbalance created the smart money that is casual of the price movement. Their activity is measured with the four simple variables. The price movements, meaning the high-low and its closing price, the trading volume, the relationships between the price movement and the volume, and the time it takes for the price movement to run its courses. This combined methodology is known as the Wyckoff Volume Analysis. In this video, I will apply Wyckoff candle volume analysis on one bar reversal pattern known as the Doji. You know it very well probably. This is the candlesticks pattern that occur when the opening and the closing prices are the same or very close to each other. The shadows can be either long or short, and there can be the various type of the jogging bars, but for our strategy it's not important to distinguish the type of the jog formation. It's only important to be able to recognize what it looks like on the chart. Its formations is said to represent the marketing decisions because the market opens trade through the period and the close near the opening price. It represents the battle between the bulls and the bears. That neither one is widely believed that represents a better reversal pattern at the top of the market than the bottom, although you will learn that this is not correct under the proper critical by the client like the candle volume analysis. You will learn how to distinguish when there's no indicators in doji formations. The perfect doji has the same open price and the close price. However, if the difference between the open and close price within a few ticks, this could be also considered as a doji. Doji candlesticks suggest the lack of the control of the market entire by the bulls or the bears. The lack of the directions is clear. Bulls move the price higher, bears move the price lower, but in the end of the market, price goes exactly or very close to the where it opened. But in the Doji candlestick highlights market increase is safe to say with it doesn't offer the things into the whether supply or demand. It's control. You have to guess the market, the next directions. This is where the Wyckoff candle volume analysis will make the difference, and the bottom of the market Wyckoff technical is looking for the test of the supply in the market. A test occurs when the price is marketable down to see if greater volume comes in the lower price. If it doesn't significant supply, it is marketable. This supply must be removed before the market can begin any substantial up move. However, if the market is marked down and no sellers ever and, and this lower price, the price will come back to the close of the lower low. While volume is lower relative to the prior candlestick with no supply presence in the current price. If the price should rise, the Doji test bar must exhibit the following parameters to be valid. It must be a low that is lower than the previous candles. Now, and it has to display lower volume. At least several of the prior candles, the lower the volume, the stronger the indicators of no supply being present here. An example of the 1 hour chart. Notice this obvious downtrend with the price start to market high highs and high lows. Now we are in the slide consolidations and we don't know if the price will go up or down, and here's our Doji test bar looking left into the chart to the few candles period to the Doji. The high was there at the around $218. The market dropped around $8 to the low of the Doji. This steps is ideal conditions for this information to occur. Pay attention to the test candlestick to the Doji bar markets and new recent low, and if there is a resistance volume, it shows that no supply is present. So you can see that this Doji is making a new low on the chart, and the volume is lower than the previous two candles. By the standing candlesticks analysis measure, most treasury volume come to the conclusion that this bar represents the indecisions to the part of the market participants. Breakdown trends would even enter short as the Doji test bar is making the new lows. However, when the wild from the window candles volume analysis presents it clear that the indecisions exists there, the chart shows there is a few sellers and this price and the price comes back to the close near 1. Within the next hours, this market started making the higher highs and higher lows, and includes almost $5 with these formations. It's important to understand that the smart money, which represents a large percentage of the overall trading volume, is not selling as lower price leave are exported. This is clearly evident, and this shown by the reducing in the total volume. If the smart money is not selling, you as the retail trade need to be aware of it. This will prevent you from the selling market bottoms and will allow you to the opportunity to establish long trade into the path of the living resistance. This example shows a 15 minutes chart again to the background is pretty strong downtrend around the 10 candles prior to the Doji test. The high price was around $225 per share. The low of this Doji test bar was around 220, which represents more than the $5 drop in the value of the stock. Once again, notice how the volume gets lower and the Doji candles test for the supply, but doesn't find increase in the interested sellers. At this lower price levels, you can see that this Doji is making a new low in the chart, and the volume is lower than the previous 3 candles. If there's no sellers, their price would increase. The price of its stocks rose nearly $2 as there were no sellers present. To stop it from the increasing in value, now let's look into Doji and the top of the market. This information is called the Doji determinant drawing up. At the top of the market, the Wyckoff techniques is looked for the site that the demand diminishing. A lack of the demand occurs when the price is making up to see if there are willing buyers at these higher prices levels, but as the price moves up, trading volumes decrease. There is a trading slide that there's no interest in the higher prices from the smart money. With no professional buying interested at the current price level, the price should fall. The Doji demand drawing up must inhibit. The following parts to be valid is scanned close must be higher than the previous candle's close, and it has to display the lower volume. At the least several of the prior candlestick, the lower the volume, the stronger the indicators that can demand the dire up. There is a 30-minute chart of the S&P pricing to the two Dojis marketing on the chart. You can see that the market has been in uptrend as the market moves up to the highest point of the round of interested buyers is drying up. We know this because the volume is greatly reduced compared to the previous candles, even though the S&P is making the new recent high and strong market doesn't behave this way. This occurs to the top of the market, and when we apply like of the candles volume analysis, the Doji indicators that as the least this phase of the up move is easier close to the end. Once again, notice how the volume gets lower, and as the two Doji candlesticks tests for demand but doesn't fit interested buyers in the higher prices levels. You can also see that each Doji is making the new high on this chart, and the volume is the lowest level to the several candlesticks later to the market drops aggressively. With these formations, it's important to understand that the smart money is not interested in the supporting the higher prices. This is evidenced by the reducing its overall volume. If the smart money is not interested in the higher prices, you as the retail trades can take its knowledge and revealed from the buying the market troops instead of the will establish the short trade into the past of the list reestablished. Here's this example of the Bitcoin notice as aggressively up move higher prices, making the higher highs and higher lows. The test candles of the Doji bar makes new recent high in the volume. Is lower than the previous 6 or 7 candles by the standard candlesticks analysis measures. Most regarders would come to the conclusion that this bar represents indications, but when viewer from the wake of the candles volume analysis perspective, it's clear then it's that no indecisions exist here. The chart showed that there is the few interested buyers at these higher prices, and the price comes back to the close near one open. Whatever you see the Doji on low volume that appear to the context of the bullish uptrend, this should give you the warning that the trend corrections would come, and anytime once you identify the candlesticks pattern, you will want to define the trigger that lets you know when to enter to the trade. A simple trigger is the low Doji. Once the candles doesn't below its level, you can open the short positions. The aggressive entry would be immediately after the candles close. The proper locations of the stop loss is above the higher of the Doji. Your level of the risk will very dependent on the length of the candlesticks weeks. Ideally, you want to have your reward. You take your profit at the least double your risk. First profit target equals to the size of the range of the Doji candles. This would give you the range 1 to 1 reward risk ratio. No ideal, but at least you can lock in some profits. The second profit target is double the size of the Doji. This will get you close to reward risk ratio. Wyckoff the candles volume analysis works in the all markets and time frame. Persistence rewards the true psychology and the sentiment of the smart money. These techniques will help you to prevent buying markets troops and selling the market's bottoms. I advise you, however, to avoid the smaller time frames like 1 minute or 2 charts, because you will witness many false signals and you will be hard to see the big pictures with all that market noise. If you learned something new and found value, leave us a like and subscribe. Until next time.